Yes. Valuation, first off, let's acknowledge, is one of the trickiest things about investing. There is a broad spectrum of people when it comes to valuation. On the one hand, on the conservative side is people that consider them to be self-value investors. And the lens that they see the world through investing is valuation first, right? They'll buy a garbage business if it's cheap enough, right? As if you give me a terrible business at 2 times earnings, I'll buy it, right? Because it's like, well, the business isn't that bad. On the other side of the spectrum is people who don't look at valuation at all. It's not a part of their process. The only thing they care about is upside potential and the quality of the business. And this is how a lot of venture capitalists invest, right? They're interested in a story, an upside, and they're willing to swing and strike out a whole lot because eventually they'll buy the next Airbnb, they'll buy the next Facebook, they'll buy the next whatever huge winner is out there. I view it as a spectrum. When I first started investing, I was very much a value investor. The lens that I saw the world through was valuation first. Over time, I've learned through trial and error and studying other investors that it actually makes far more sense to look at business quality first and actually look at valuation as a component of investing, but not everything to do with investing. When you're judging whether or not valuation is important, I think it matters greatly where this company is in its growth cycle. So imagine for a second that we found a business today and we have huge plans for our business over time, and our business goes on to be hugely successful. In the beginning, when we were hyper-focused on the opportunity and growth, it's not uncommon for us to have very little revenue and no profits. In fact, we could be losing money for the business because all of our energy is focused on top-line growth, executing on the opportunity. As we're successful and our business matures, suddenly our losses decrease over time and we eventually reach break-even period. And then eventually, once we're big and established and mature, the focus becomes profitability. And we focus all of our energy on profits at the time. But it's a bit of a slope that companies go through, where there's a hyper growth phase in the beginning, then they kind of reach a maturity phase, and then they go through the decline and the death phase. The problem that investors get into with valuation, and this is a mistake that I made, is they judge a company by its profits before the company is focused on generating profits. This is, for example, why companies like Amazon have perplexed investors for 2 decades now. Jeff Bezos focused all of Amazon's energy and resources on top-line growth, acquiring customers, rolling out products, rolling out services, doing everything he can to capture market share and grow revenue. Profits were not a focus at all. In fact, he tried to run the company at essentially break even for a couple of years in an effort to drive that top line higher. So because profits were not the focus, the price to earnings ratio, which is a very popular metric for judging companies' value, didn't work because the earnings power of the business, the E in that equation, was understated, way understated to what the business could do. So the PE ratio was way overstated. So if you were looking at Amazon any time in the last 20 years and you just look at the PE ratio, you'd say overvalued, pass. And you would have missed out on a multi-bagger returns. Conversely, if I'm considering a company for investment, such as Adobe, such as Apple, such as Microsoft, these are mature companies, the hypergrowth is gone, and these companies are focused on profits. They are focused on delivering bottom line profitability. For companies like these, I think the PE ratio can be a great tool for figuring out valuation because the earnings power of the company is meaningful. It's what management is focused on. So if I was going to make an investment in a company like Adobe, I would very much pay attention to the PE ratio of the company. But investors get into trouble when they look at growth companies with a value investor's lens, because that company isn't focused on profits, it's focused on growth. So you have to be able to shift your mindset to focus on valuation in some cases when a company's mature, and you have to be able to de-emphasize valuation in other cases when a company is in a different stage of its cycle.